Hi, I'm Jimmy Becker. Today we're going to present and explain the 5 most important topics to understand about college financial aid. How much does college cost? What is financial aid and how is it determined? What is the role of the financial aid office? How do you evaluate competing financial aid awards? And some key do's and don'ts. Let's start with how much does college cost? As you might expect, there's a wide range of costs depending on the type of college. Private colleges and universities in and out of state can have a cost of attendance of up to $75,000 per year. These are schools like Harvard, NYU, and Boston University. Then there are state colleges and universities out of state, like Virginia, Texas, UCLA, that have a cost of attendance of up to $65,000 per year. And state universities in state, like Framingham and UMass, have costs of attendance of up to $32,000 per year. Finally, the least expensive are community colleges, like Bunker Hill and Middlesex Community College, which cost around $15,000 per year to attend. Now bear in mind that these are the list prices, not the net prices. To better understand what net price is, the price that families end up paying, let's start talking about financial aid. Most people think of financial aid as having 3 components: grants, sometimes known as scholarships, loans, and work study. Don't confuse these. Only the first, grants, are truly financial aid. Loans are just that and have to be repaid. A student loan is no more financial aid than is a car loan or a home mortgage. When we go to buy a car and take out a loan to finance it, few of us would consider that to be financial aid. It is no different with a student loan in college. Similarly, work study is not a gift. The student is being paid to work at a job, and this is no different from any other job. Again, the only true financial aid are grants that do not need to be repaid. To blur the financial aid picture more, there are 2 types of financial aid grants: need-based and merit-based. Need-based aid is based on the family's ability to pay as calculated by the FAFSA financial aid form. We'll get to that in a moment. However, keep in mind that colleges are under no obligation to meet a family's full financial need, and most colleges are unable to do so for most of their students. Merit-based aid is based on whatever criteria the college chooses to incent the student to attend. Colleges vary greatly in their use of merit aid. For some, it is much of their financial aid budget, and others only offer need-based aid. Let's talk about loans. To pay the net cost of college, that is after any grants, families are faced with either paying the fees from cash and savings or borrowing the money. If you're borrowing the funds, there are 3 types of student loans, and we'll say student in quotes for reasons we'll explain. The first and best option for everyone are the federal direct loans, sometimes known as Stafford loans. There are a few key points to know about them. They are loans to students and not parents. The interest rate is fixed and other fees are low. These are eligible for income-based repayment programs. Unfortunately, the federal government limits the amount of borrowing, and the maximum amounts are low relative to your need. It is roughly $28,000 of borrowing over 4 years for most students. For financially independent students, the maximum borrowing is higher. To complicate things slightly, these loans can be subsidized or unsubsidized. The difference is simply that with subsidized loans, the interest does not begin accruing until after graduation. This is a valuable benefit and can save money in the long run. Subsidized loans are typically issued to families with higher financial need as determined by the FAFSA. PLUS loans are also federal loans, but they are made to parents, not students. Hence, the acronym stands for Parent Loans to Undergraduate Students. These are not as good as the direct student loans for a couple of important reasons. First, the interest rate and the origination fees are high and may be even higher than private student loans, which we'll cover next. Second, even though these are federal loans, they are not eligible for income-based repayment. Remember, these are obligations of the parent and not the student. The third option are private student loans. These are all other student loans that are issued by financial institutions and state agencies such as MEFA in Massachusetts. These loans may have fixed or variable interest rates, and they may be obligations of either the parents or the students, or sometimes both if the lender requires a parent co-signer. The fees and rates for these loans may be more attractive than the PLUS loans, and there's no inherent advantage to PLUS versus private loans. The most important commandment to remember, and arguably the hardest to manage during the pressure-packed time of college acceptance, is do not overborrow. This is equally true for both parents and students. Student loans have a special quality, which is that they are not eligible for discharge or restructuring in a bankruptcy. So it is critical to understand that any student loans you take out will remain with you for your lifetime until you've paid them off in full. If you get behind in your payments, the fees, penalties, and unpaid interest could haunt you for a very long time. Don't borrow more than you can comfortably afford to repay. The financial aid determination is complex. It usually starts with the family filling out the FAFSA form. Free application for federal student aid is what it stands for. This asks lots of questions about the income and assets for both parents and students. It is an intrusive and comprehensive form, and the colleges learn even more about your financial status than does the IRS. This is because it requires disclosure of assets as well as income. Typically, your retirement assets as well as your primary home, if you own one, are excluded from the assets. Most private colleges also require you to fill out a second form, the CSS profile. This requires even more disclosure. For example, information about non-custodial parents that is not included on the FAFSA. From this information, your EFC, the expected family contribution, is calculated. The EFC is an algorithm created by the federal government and is their best determination of how much your family can presumably afford to pay for a single year of college. It uses the inputs of the income and assets of the family, as well as some other information such as other siblings that may be in college to determine this amount. As we mentioned previously, keep in mind that colleges have no obligation to meet the full financial need as defined by the EFC. This is just what they use as their guideline to make financial aid determinations. Once the college knows the applicant's EFC, they factor in any merit considerations and outside scholarships. From these inputs, they determine the aid award, that is, the grants they're going to offer the student. The net price of college is then simply determined by subtracting the aid award from the full cost of attendance. This is the financial responsibility of the family for 1 year of college. Again, note that loans and work study are not part of the determination for the net price of college. Your EFC is calculated by factoring in parent income with parent assets, student income and student assets to arrive at your expected family contribution, the amount of tuition and other expenses you are expected to pay. Parents are expected to contribute up to 47% of their adjusted gross income at high income levels, and parents are expected to contribute up to 5.6% of their non-retirement assets, including 529 savings plans and any brokerage or mutual fund accounts. Students are expected to contribute 50% of their income over an adjustment of $6,300, and students are expected to contribute 20% of all their assets. The formula for determining the actual EFC is complex, but taken at a high level, student income is weighted the highest, and then parent income is weighted the next highest. Student assets are weighted higher than parent assets. This brings us to the role of the College Financial Aid Office. They are not your friend nor your trusted counselor in this process. Much like dealing with a car salesperson when buying a car, they represent their interests and not yours. Their goal is to get you to enroll at their college, regardless of what you may be able to afford. To do so, they will offer you all the loans you need. Your goal is different, and it is to get the most appropriate and affordable education that is available to you. The Financial Aid Office is not going to tell you that you cannot reasonably afford to attend, and you shouldn't expect to get that guidance from them. Remember, when you walk into a Chevy car dealer, you don't expect the salesperson to tell you that you're a better fit for a Ford and you should go across the street to buy one. He or she is going to try and sell you a Chevy. In that situation, you understand their role. With college admissions and financial aid, it is really the same dynamic. Don't look for guidance and counseling from them. They want to sell you on their school. When you are accepted to a college, they will include a financial aid award letter as part of the package. These award letters are not standardized, and they may be structured in a way to make it complicated to compare one school's package to another. Remember, the net price should be your point of comparison. To get the net price, subtract the aid award from the cost of attendance. Loans do not factor into the net price calculation, as the loan options should be similar from each school. What really matters is how much your family has to pay, and that is known as the net price. Also, importantly, you should understand what commitment, if any, you have from the school to maintain this level of aid for the next 3 years of college. Assuming your financial situation does not change, you will resubmit the FAFSA each year. You want a clear understanding whether the college is willing to offer you the same amount of aid going forward. Once you have clarified the net price and the future commitment each college is making, then you are in a position to compare different financial aid offers. Let's talk about some key do's and don'ts. First, don't assume that if you're accepted, the college will make it affordable. Every college has their own formula and resources for awarding aid. College is under no obligation to meet your financial needs, and only very few can. Only the wealthiest schools have the resources to do so. The bottom line is most colleges simply cannot afford to do so, and don't expect that an acceptance letter is an affordability guarantee. Second, do appreciate that less selective colleges may be more generous. In order to attract more students and increase their ranking, less selective schools may be willing to entice you with a better aid package. Less selective colleges, and you can think of those as your safety schools, may offer you a more generous financial aid package because they want to encourage you to attend their school for at least a couple of reasons. First, they expect that you may have offers from higher ranked schools and they need to compete with those schools. And second, your SAT scores and GPA are going to be above their average values, and they view your acceptance as a chance to increase their statistical averages and thus their rankings in the various college ranking services. Third, don't think independent scholarships will help much. Independent scholarships may be deducted from your grants, leaving you with the same amount of loans to take out. There is a practice known as scholarship displacement, which occurs when an institution reduces the financial aid award of a student by the same amount of their private scholarship to redistribute funds to other students. Private scholarships often lead schools to reduce other types of aid, dollar for dollar, entirely at the school's discretion. So before you spend a lot of time researching independent scholarships, ask your college's financial aid office what their policy is and if they'll be reducing your grant aid. If that is the case, then you probably should not bother. 4. Do understand many private colleges are financially shaky. Research the financial health of your college before accepting their offer. The easiest way to do this is to research the size of a school's endowment, both the endowment's total size and on a per student basis. The correlation between a school's financial health and its endowment is nearly perfect. 5th, don't assume financial aid is guaranteed after the first year. The FAFSA and financial aid applications are updated and resubmitted every year. 6. Do appreciate that college is not for everyone. There are lots of fulfilling career options that do not require attending college. Don't feel obligated to go to college if it's not for you, and don't feel obligated to go right away. It's an expensive choice, and make sure it is the right one for you. A perfectly suitable option for many students is to start with a community or junior college and see if that experience is what you want. If so, you can always transfer to a 4-year school at any time. Number 7, don't fall in love with a college you cannot afford. The biggest takeaway from this video is don't overborrow and risk your financial future. When you take on student loans, you cannot get out of them by declaring bankruptcy or by any other means. If you overborrow, you will be living with high debt payments for a very long time. Proceed carefully. Navigating the college financial aid process is complicated, fraught with anxiety, and potentially differing expectations from parents and students. The final guidance with which we'd like to leave you is to encourage parents and students to communicate early and often through this journey. Parents should be clear about the financial resources they're able to commit and the comfort level they have about taking on student loan debt, either for themselves or the student's responsibility. Just as we intuitively know not to buy cars or houses that we cannot afford, the student should not consider schools that may be beyond the financial reach of the family. Trying to comprehend the burden of taking on student loans is quite abstract and difficult for a teenager to grasp. Thus, students and parents need to move through this process together.